Financial statement analysis is very important because it will help the business owners and the key custodians of financial accounting information to be able to compare between two statements, mainly to assess the performance, whether the institution or the firm is performing better than the other firms within the same industry or is performing better based on the previous year. So for financial statement analysis, it will give you the following purposes. One, to evaluate the company's performance. This could be past, present, future, and also to ascertain the financial position as of now. It will also give you a comparative analysis, inter, and industry analysis. And inter, we're talking about within itself, inter amongst other companies. So it will finally help you apply analytical tools and skills useful for decision making. So financial statement analysis is not only about figures, it will help you align your decisions based on how the economy is and the factors that are affecting the growth of an economy. So with this knowledge, you'll be able to give a report as to whether this business could survive in a particular industry or not. So there are a few ratios that we're going to talk about that will be very key in our discussion. So quickly to peruse through, as I've mentioned, the performance that we're going to talk about will be past, present, and future. And also we're going to ascertain the growth of the business in its earning power and solvency. Now, businesses have a key role of survival and profitability and market share. So regarding survival, it will be imperative that we learn profitability ratios, the solvency or leverage ratios. So these ones will give you a picture, especially with regards to income, the ability that a firm may have to generate excess income over its operating expenses. In solvency, we're going to look at how business is performing regarding its financial obligations. So there are about 5 ratios that we're going to look at. So this is a picture of effective financial statement analysis. Ultimately, we want to have a broader picture of how the firm is with regards to internal and external factors. External, look at what is surrounding the firm outside. These are macroeconomic issues, industry factors, and internal are issues to do with the company itself, the strategies and the objectives that the firm may have. So down, we are going to use 2 key tools. There's what is called the financial ratio analysis and also the comparative statement analysis. Now, to start with, financial ratio analysis, we'll use a few key ratios that are going to be will require you to memorize formulas or know, in fact. So these ratios will be as follows. So what we call the liquidity, profitability ratios, efficiency ratios, leverage ratios. All in all, these ratios will be tackling these key thematic areas: the liquidity of the firm, how are we able to meet our short-term obligations, the profitability of the firm, how are we able to generate excess sales over expenses, and how is the reliance of this particular institution on debt. Like we mentioned in the previous unit, that there are creditors and banks that want to understand whether they can loan you an amount, but before they do so, not only will they want to know how reliable you are, but the ability. If you are over leveraged, it means you are over financed by debt. So this is what we call ratio analysis. From our grade 5, a ratio is simply an expression of one unit data to another. So in ratio analysis or financial ratio analysis, we're actually comparing what? Different financial statements. So in every particular public company, you'll be allowed to publicize your accounts in the press for people to analyze and see and express interest whether they could want to invest in it or not. So to do that, they'll need to compare the performances. Of course, right now, there are a few issues regarding the performance of Zambia, saying you are fabricating some figures to show an impression that we are doing well. Whether that is true or not, this is the lesson we're getting. So you need to have an eye of a financial manager to see whether there's growth or not. So there are 5 key categories of these ratios. So they stream from what are called liquidity, profitability, efficiency, leverage, and investment ratios. So to start with liquidity ratios, we have the 2 types of liquidity ratios, which are called current ratio and quick ratio. These ones are important to ascertain how the firm is able to meet its short-term debt obligations. Then the other ratio is called the efficiency ratio, which is there to show you how efficient we are using our resources in the business. So it will give you a picture of how efficient the managers are utilizing the resources, the assets, the buildings, the land to generate sales. The leverage ratios, these ones are mainly concentrating on debt financing. How are we able to, how are we financing our firms? Is it over leveraged? Is there more liability, more external funding than our own? Then that's the problem. Then investment ratios really cater for the shareholders to giving you a picture of the performance of the investment in terms of shares. Now to break these ones down, each one of them have particular description of the ratios. So the ratios that are under liquidity, I've mentioned we have the current ratio, which looks at the current assets divided by current liabilities. Now, just to take you aback briefly, current assets are simply what we own as a business. So in terms of assets, we have what? Current assets and fixed assets. So in the balance sheet, the order of assets is as follows. The most liquid is down here, which is what? Cash, then followed by cash at bank, then followed by what? Debtors, then followed by, debtors are called trade receivables, then followed by prepayment, and followed by stock or inventory. So current liabilities are what we owe payable within a period of a year. So when you're dealing with current ratio, the formula is simply the current assets over the current liabilities, and the market rate is 2:1. So meaning for every 2 assets, at least we must have 1 liability. Then the quick ratio is simply the current assets minus the stock or inventory divided by what? The current liabilities. So the reason why we remove inventory is in an event where you need to pay immediate debt, inventory is less convertible into cash unless you have a market for it. So this is the part of the current assets that we're going to consider. So we move on. We also have what we call efficiency ratios, which are as follows. They're also called activity ratios. So efficiency ratios, we have what is called the inventory turnover, we have what is called the receivables turnover, and the total asset turnover. The inventory turnover basically looks at how long it takes for you to convert your inventory into what? How long into sales? How long it will take for you to actually make a sale? So it is given by cost of goods sold divided by the average inventory. Or you can multiply by 365 days. The inventory turnover is very important because it gives you a picture of whether you are keeping stock too long or you are actually selling within a correct period of time. So there's what we call lead time in inventory management. It becomes a cost for an institution to keep inventory for too much a time, because sometimes it will accrue associated costs such as storage and other costs such as security, etc., etc. Then we go to what are called receivables turnover. Receivables turnover can come in two forms, as account payable and account receivable. So receivables actually debtors. So it is credit sales divided by the account
Hear you,
receivable.
Collins?
Yes.
Oh, okay. I couldn't hear you. I don't, maybe it was my network.
Oh, okay. But are you getting me? Is everyone getting me?
Yes, you're loud and clear.
So the receivables turnover talks about how long our debtors are able to pay us our money. Then the creditors turnover really talks about how long we take to pay our creditors for the credit purchases. Then we go to another ratio, which is leverage ratio. This one basically talks about money, how our proportion of debt to equity is. So we have the debt ratio, which is given by the total liabilities over total assets, and the long-term debt to equity, which talks about the long-term debt divided by the owner's equity. So this is a ratio of how much was pumped into the firm by the owners through the shares and how much was actually borrowed from the bonds and the bank loans. Then finally, we have the profitability ratios, which have what we call the gross profit margin, net profit margin, and the return on equity. Gross profit margin is simply gross profit over sales. Net profit margin is net profit over sales. Return on equity is simply net profit over the average owner's equity. So these are the ratios that we shall look at, and also the investor ratios that we'll talk about later on. So the liquidity ratios, like I mentioned, when we're talking about liquidity, we're talking about solvency. So solvency is mainly ability to pay short-term debts as they fall due. This is within a period of a year. So current ratio is current assets over current liability. The benchmark or the market ratio is 2:1. The quick ratio is also called the acid test ratio, which is simply current assets minus stock over current liabilities. The market rate is 1:1. For every one asset, there should be one liability. Then we go to the profitability ratios, which are very imperative for the survival of the firm. Profitability basically looks at ability to generate excess income over what? Expenses. So we have three main focuses. There's a focus on gross profit, the focus on net profit, focus on equity, assets, and the capital employed. So the following are the formulas that we use. Gross profit over sales times 100 is the GPM, gross profit margin. Okay, so the gross profit over the cost of sales times 100 is the gross profit margin. So we'll look at how we do the computations later on. Then when we go to our net profit, is simply net profit over sales times 100. So this one, we remove the tax aspect. So it is net profit before interest and tax times sales. Then when we go to profitability ratios, we're looking at the return on assets. It's simply the net profit over average total assets times 100. So this one basically looks at the contribution that assets have towards generating what? Our net profit. And also we have what we call the return on equity, which is net profit over the total equity. It simply gives the ratio of the net earnings that result from the equity. How much of this equity contributes to the net profit or the net earnings. Particularly, shareholders are interested in this ratio because it also gives them the earning power on their investment. So because the equity has generated a certain particular profit, which will be later subdivided as dividends towards the capital contributions. So this is a structure of return on equity analysis. Then the asset management ratios, which are also called efficiency ratios, look at how we are utilizing the assets of a firm to generating what? A sales volume. So it shows how much of a quarter of assets contribute to the sales. So we have what we call the asset turnover, which is sales over assets. So this one talks about how much an asset contributes to the sales. So the higher the asset turnover, the more the firm is using its assets to generate what? Sales. We also have the debtors turnover, which gives you the period of time it takes for us to pay our what? Trade receivables. Trade receivables are debtors, the monies that we are expecting. Trade payables are creditors, monies that we are expecting to pay. So the debtors turnover, credit sales over debtors. The creditors turnover, credit purchases over creditors. So this is called the account payable turnover or creditor turnover. You can multiply it by what? 365 days to get it in the number of days. So whenever we get a higher creditors turnover, it means we're taking very little to pay our debt, which is a good thing. Whenever we have a higher debtors turnover, it means we're taking very little time to be paid by our debtors. The people who owe us money are called what? Debtors. The people we owe money are called what? Creditors. So we also have what is called the stock turnover, which gives us a number of time we are able to turn our inventory into sales. So if we have a higher stock turnover, meaning we are taking a little time to do what? To convert our stock into sales. So this is given by the cost of goods sold over the stocks. Then this is where we ended, where we have asset management ratios or activity ratios. There's one other ratio which is called the net working capital turnover. Working capital is current assets minus current liabilities. So sales divided by working capital gives us the net working capital turnover. So the net working capital turnover gives the measure of how efficient the business is using the available assets. The working capital looks at the assets that are available to generate revenue. So working capital turnover measures the amount of net revenue generated in monetary unit of the working capital. So this one varies from industry to industry. Then we also have the leverage, which are also called the gearing ratios. These ones give us a percentage of the capital employed that is financed by debt. So if we have a high gearing ratio, meaning our dependence on borrowing is higher, the higher the level of borrowing, the higher the volatility of the profits. The lower the gearing ratio, the higher the dependency on what? Equity financing. So equity financing basically looks at the money that come from our very own shareholders. All right. Then these are the following ratios that you use under leverage ratios. So we have the debt over total assets ratio, which is simply debt over total assets times 100. We have the debt to equity ratio, which is debt over total equity times 100. We also have this important ratio, which is called the times interest earned. This one measures, we will actually call it the TIE. It measures how many times in a year the company has earned the annual interest costs associated with servicing debt. Okay, it's actually used by most bankers to ascertain a firm's ability to pay their liabilities. Normally, bankers will look at an institution's TIE. It ought to be 2 or greater for them to be in the reliable bracket. Then the last ones are the market ratios, where we have the PE, which is the price earning ratio. Price earning ratio looks at the shareholders' earning power. So not all shares have the same earning power. So if you want to buy shares from a particular company, you would be keen and interested to looking at the earnings per share. So the higher the ratio, the higher the perceived quality of the earnings in the market. So you look at the PE for the shares in a particular company with relation to the markets. So if your company is saying we're doing very fine, ask for the price earning ratio. Then we also have the dividend yield, which is simply gross dividend per share over the market price per share. Other market ratios are as follows. Earning per share is net profit after tax over the number of issued shares. dividend per share is the dividend over the number of ordinary shares, and the dividend payout ratio is simply dividend per share over the earnings per share. So quickly, I'll take you through two financial statements that we're going to analyze. So now I'll need to take my time so that you're able to really relate. So I'll need two financial statements that will make it quicker for me to navigate between the two. So before I go any further, are there any questions that any of you have or any concerns? Ratios are many, quite right, but trust me, this topic is the easiest one because these ratios, you only have to choose any of these available ratios that are there. So it's not all of them that you need to do. You need to do a particular number of ratios. So looking at this is called our financial statement of the financial performance of the company. The main aim of this book is to show how much profit has been made. So already you can see key things in here. We have the sales for 2010 and 2011. Cost of goods sold. When you subtract the sales minus cost of goods sold, you get the gross profit. Then here we have the expenses. So whenever we subtract expenses from our gross profit, what we get is our net profit. Okay, are we together? So we have our sales, we subtract the costs of those sales, we get our gross profit. From the gross profit, we subtract the expenses, we get our net profit before tax. Then you remove the tax, we are going to get a net profit after tax. Are we together with this financial statement here? As basic as that. For now, you may not really need to know the formats, but I want you to know the ingredients that are in here because they are very important in us analyzing the financial statements or the ratios. So the other important book is this, which is called the balance sheet or the statement of the financial position. It basically has the current assets, the non-current assets, the current liabilities, the non-current liabilities, and the shareholders' funds. So this book is very cardinal because it shows you the position of the business as at a particular point. All right. So in the financial statement, we have the following. The current assets. The current assets have what? Bank, account receivable, which are debtors, and inventory, which is stock. This is for both 2010 and 2011. Then the non-current assets are also called fixed assets, which have what? Fixed assets and land. Collectively, when you add the current assets and the fixed assets, the total is called the working capital or the total assets. Then the balance sheet has to balance. So we have the accounting equation, which we by now know that assets should be equal to capital plus liabilities. So when you add these liabilities, both the current and the non-current, you add them to the capital. We should get the same figure here. That's why it's called a balance sheet. So on the current assets, we have what is called the account payable. These are creditors. The income tax. Then we also have the non-current. Non-current means long-term. So the long-term liabilities, we have this loan, could be a bank loan. When you total them up to the capital that we have from ordinary shares and retained profits, collectively, when we add this, we're going to get 1020, which is the figure that we have there. So the same applies with the other year. Basically, the financial position gives you a picture of how much the firm has at a particular moment. Now, without even going so much afar, if you're asked to calculate our current ratio. Remember, current ratio is given by what? Remember, current ratio is given by? Do you remember the formula for current ratio?
Sorry,
Uh-huh.
the formula for the current ratio.
Uh-huh. So we talked about a number of ratios, okay?
Sorry.
We talked about a number of ratios. We talked about what? Liquidity ratios. Under liquidity ratios, we talked about two kinds of ratios, which are what? The current ratio and everybody hear me?
Yes, you're very loud.
Okay, so under current ratio, we talked about, under liquidity ratios, we talked about two kinds of ratios.
So the
We talked
current
about
ratio and you said, is it acid? Is it quick acid? Quick ratio, I mean.
yes. So we talked about what? The quick ratio or the acid test ratio, and also we talked about the current ratio. These are the liquidity ratios. So using this statement, let's with ease try to calculate these ratios. Okay, so under current ratio, we need to identify from the previous yeah, so which ones are we picking? For the current ratio, you've told me already the formula. We'll say current ratio is equal to what? Current ratio, you've told me, is equal to current assets over current liabilities. So what is the current ratio for what are our current assets for 2010? What?
Do we get the
774.3 over the current liabilities, which are what? 321.8. Okay. And for 2011,
6220 over 364.8.
364.8. Okay. So quickly, hoping you are going to follow. So these are the ratios here. So the current ratio over current liability. So 574.3 over 3, 2.1. So here we have what? 1.78. Okay. Here at 622 over 364.8, we have what? 1.705. So the market ratio here, we said ideally supposed 2 to 1. Both of them were below the market benchmark, but they're all performing well as long as the current assets are more than the current liabilities, except that the performance was higher in 2010 than it was in 2011. Then the quick or the acid test ratio.
Sorry, Collins, let me just take you back a bit. Sorry to interrupt. I'm a bit behind. How did you get that 2 to 1?
2 to
The
1.
ratio of
I'm saying the 2 to 1 is the benchmark, the market rate that we are comparing these two. So this one that we have here is 1.78 to 1. Because when you divide here, 1, here we get 1.78. If you're going to convert this to a ratio, it's 1.78 to 1. Here, this is 1. This is 1.705. So this is 1.705 to 1. So I'm saying the acceptable market rate is that for every 2 assets, there should be 1 liability. Despite them being lower than the market rate, it was higher in 2010, but all of them at least had more assets than liabilities. Okay?
Oh, it's clear.
Then from here, it was 1 to 1, the acceptable market rate. 1 to 1. So here, we subtract current assets minus inventory. So when we go into our statement, okay, when we go into our statement, you find that our assets, we need to subtract the inventory. So here, the inventory of 300 needs to be subtracted. Here, we need to subtract the inventory of 370. So when you subtract it, we're going to have our current assets minus inventory. This is 274, here 251. So in this case, we had 0.85 to 1. Here we had 0.69 to 1. So performance was below par for both of them, except that 2010 performed better. All right. So this is on the liquidity ratios. Are we clear?
Yes, it's clear.
All right. Then we go to the asset turnover. So asset turnover simply gives you how we're utilizing our assets, how much assets contribute to the sales. So here you go to the statement firstly. You know the formula sales over total assets. So when you go to these statements, our assets are what? For 2010, our total assets are 1020. All right. So this is the 1020, 1021. Then our sales, where do we find the sales? The sales are found in the which statement? We'll find the sales in the income statement. So here is our sales. So what is our sales? 2240. So 2240 divided by what we've just found as 1021. So 2240 over 1021. Here we get 2.19. The same, you get the readings from the other, you divide them. So basically, we are using the formula to just get the figures there. So we go to creditors turnover, stock turnover, and our creditors turnover. We divide the credit sales over debtors for each of the 2 years. Cost of goods sold over stocks, credit purchases over creditors. So you get the figures there. You can multiply them by 365 if you want to express them in terms of days. So just on these 2 kinds of ratios, you will need to have an analysis. For instance, at the final end, you give a report, for instance, pertaining to asset management. We discovered that asset turnover or inventory turnover had gone slightly down from 5.8 to 5.58 times. So meaning the inventory turnover is close to industry. You compare to the industry, you'll be given a benchmark down in your question to say maybe if we're dealing with Thai, your market rate must be so and so. So the benchmark is often given. The benchmark for market industry may be, for instance, profitability ratio was 25. But when you went to your calculations, you found that 2010 had 22 and 2011 had 27. So you can comment to say the performance improved, at least slightly. Then when you go to the net profit margin, you discover that the benchmark is 7%, But in 2010, we've calculated 7.1, and in 2011, we had what? 6.1. So you need to investigate. Of course, we know what differs between these two. If you don't manage your sales, your expenses very well, because gross profit, when you subtract expenses, that's what gives you net profit. So here in 2010, they were able to manage their expenses very well. But in 2011, meaning the expenditure was high, so this could have affected their gross profit margin. So it's more than just about figures. In short, you need to give an analysis in an objective way after understanding what each of these ratios really imply. All right. At this point, maybe I can pause to say this is an important analytical skill that you should have. It is a full 25-mark question of your exam, which always comes at the latter part of FMA. So your course consists of both costing and financial accounting. So you need to very much really apply the analysis. No wonder when you go to your assignment, this carries about 47 marks. The highest marks allocation, not in this calculation because figures don't lie. So you need to give your expression so well. All right, together.